Good morning. Let's get started today. I'm going to try to finish up this multiple time series modeling and also the concept of co-integration. And the main ideas are sort of summarized in the first slide that we have here. And this slide is probably a very general framework that gives you an idea about how to look at not only the regression but also time series, especially if you are going to deal with autoregressive models. It's nothing but the right hand side x of t is nothing but the past values of yt. Okay, could put yt minus 1, yt minus 2, however many lags you have. Okay. And two important things that I go through in the calculation in regression is that this quantity y x prime, that is supposed to be the covariance matrix between y and x x prime inverse is supposed to be the variance covariance matrix of x. Okay. So those are the two important quantities that go into the calculation. The question I think is that in the time series context, what really goes into that. Okay. The time series context, the x is going to be the past values of y. Okay. For that reason, this y x prime is going to be like auto covariance matrix. X prime is like variance covariance matrix of yt. Okay. Just briefly, I think, if you can see the connection between the two, I think rest of the calculations are fairly simple. Okay. So what we have here is that yt is equal to c times xt plus epsilon t. So in the case of, so let us take, for simplicity, I am going to take AR1 model. AR1 model is going to be yt minus 1 plus epsilon t. So the C matrix, I think we also denoted by pi matrix, and this is given as y x prime. In this case, it's going to be y matrix and y minus 1 matrix, which is just lagging it, and times y minus 1, y minus 1 prime inverse. So that is the matrix we are going to use. So this is the auto covariance matrix. Auto covariance matrix. This is the variance covariance matrix of, I'm going to write it as covariance matrix of yt. Okay. So if there is no dependence, if there is no time dependence, you should expect the auto covariance matrix to be 0, right? It should not have any information. Okay. So in the case of time series, if we have AR2 model and AR3 model and so on, how do you check how many lags you need? Okay. So the key part of vector autoregressive model is to decide what should be the order of how many lags you want to include in the model. For P, how do you decide on P? How to decide on P? I think general procedure that we are going to use here is that you can look at this sort of auto covariance matrix times covariance matrix, and the other alternative people have used in the past is that taking the same thing but standardizing it in such a way that you can call it as autocorrelation matrix. Exactly the way it is done is that it's done as follows: y minus 1, y minus 1 prime to the power, instead of using minus 1 on the right hand side, you can use it minus square root matrix here times y minus 1 prime times y minus 1, y minus 1 prime to the power minus f. This is sometimes known as autocorrelation matrix. This is autocorrelation matrix of lag 1. Sometimes they write it as the big symbol here, write it as rho 1 matrix. Let's say estimate matrix. Okay. This is autocorrelation matrix of lag 1. Sometimes they call it as cross correlation matrix of lag 1, mainly because if you look at this y and y minus 1, it's going to look at the correlation between not only the one series with its own lag, it's also going to look at one series with the lags of other series, right? Lag 1 of the other series. For that reason, in some cases, they may call it as cross correlation matrix. Correlation. Okay. So generally, how do you decide between, say, let us say whether you want to fit an AR2 model versus AR1 model? How do you decide? How does one decide between two different models? Okay. So let me give you basic idea. I think the way it is you could follow. It's done as follows. Okay. So essentially, it's a simple calculation that goes here. So suppose I have this is the question I'm asking you. Suppose I have AR1 model yt minus 1 plus epsilon t, and you want to check if the alternative model is AR2 model yt minus 1 plus pi 2 yt minus 2 plus say some other error term. I'm going to call it as epsilon t star. How do you decide between the two models? Okay. I think last time I mentioned there are two approaches that you can take. One approach is that you can fit this model, second model, right, and check if this pi 2 coefficient is 0 or not. Okay, that's one way to do it. An alternative procedure that I tend to use in practice is as follows. So I would fit this model here and construct the error covariance matrix. I'm going to write error covariance matrix. Okay. So let me call this error covariance matrix as something like S1. Okay. So if you are dealing with time series of dimension m by 1, obviously the error covariance matrix is also going to be of dimension m by m. Okay. Then you fit this second model that you have, and this model here, again you can fit an AR2 model. Essentially, if you are going to run a regression type of calculations, so in addition to running a regression on m lag 1 variables, would also include additional m lag 2 variables. So this will be a regression based on 2m predictor variables. Okay, it's going to be a long regression that you should get. So again, based on this, you can compute the error covariance matrix, which I'm going to call it as S. This is also going to be of dimension m by m, right? M by m. Okay. I think the question I have for you is the following, right? If pi 2 doesn't make any difference, if pi 2 is close to 0, what kind of numbers you should see? What is the difference between these two? Adding the second lag doesn't make any difference. If that is the case, you should expect these two numbers to be same, right? So I would follow that logic, So the key quantity that goes in here is supposed to be this U statistic, which is given as determinant of S divided by determinant of S1. Okay. So if you look at this, which number is going to be on the average smaller, S1 or S? Because this is a model with more variables included, right? So you should expect the error covariance matrix in terms of determinant should be smaller than the other one. Okay. So generally that is the logic we use, and the depending on the number of parameters that goes in here, I'm just not going to write too much here except that to say that because this number is going to be larger than this number here, you should expect the u to be a fraction. So for that reason, I'm going to write it here as the following. Okay. Roughly, I think this is the idea that you should use. If there are t number of observation minus the number of parameters that gets used in the difference in the number of parameters that gets used. For instance, here, how many parameters we need to estimate here? Pi 1 is going to be of dimension m by m, right? You'll be estimating m squared numbers, right? In the second case, you are going to have m squared plus m squared here. So you'll be estimating 2m squared. So the difference between the two is going to be just m squared. So roughly, I think that's a logic I would use. T minus m squared times this log of u, okay, should follow chi square m squared distribution. Okay. That's a simple logic that you can use in order to check if it is this is called likelihood ratio test. Okay. Likelihood ratio test. Okay. Any question on this? Any question on this? Okay. So now we have a way of deciding how many lags we want to include in a stationary series. Okay. I think it's not all that simple because of the following reason. The reason being that if you have a time series, it is not exactly the regression case, mainly because you need to decide if the process is stationary or not. Okay. So you have this additional constraint that you need to take into account. Okay. So you need to worry about the procedure I mentioned there. It mainly applies for stationary series. So the other concept that you need to worry about when it comes to time series is the stationarity concept. Okay, stationarity. Okay. So as I mentioned before, I think if you know how to compute the eigenvalues of AR1 matrix, so essentially eigenvalues of this matrix pi 1 in absolute value should be less than or equal to 1. So that is the condition that we need to find out. Okay. Okay. But when it comes to financial time series, often you are going to face time series which are non-stationary. Okay, that is the case, and we are going to study an important situation where you want to look at not just the modeling AR, whatever model you want to fit, but also you have to simultaneously check if the process is stationary or not. Okay. So I'm going to take a concrete example. I think I started with that last time. This is the US hog data, and the reason why I'm not doing any financial thing is that you will do that for your assignment. But let me show you the US hog data. Okay. This is one of the most celebrated data sets. People use it all the time in their research. So essentially what I have here is the first 5 columns are supposed to be the series related to hog market. hog supply, hog price, corn supply, corn price, and wages. And then I also took the lag 1 just to show you that the connection between this and the past information. Today I am not going to use that one, so I am just going to stick with this first 5 series here. Okay? And the reason, the ultimate goal is to see the connection between the hog supply, which is the output, corn is one of the input, wages is another input. So we want to see the connection between input and output relationship. That was the main idea here. Okay, so it's a lot of we have studied this data quite extensively, and we have used it in our papers. But I think here the goal is to show you. I'm going to take this 5 series and go through this. So those are the 5 series. Okay, and you can see that by looking at all the series here, do they look stationary or non-stationary? All the series look non-stationary, right? So you can quickly check it by looking at the autocorrelation function. I'll just use the hog supply to show you what the autocorrelation function is. So let me go here. Autocorrelation function of, say, hog supply. So that's what you see. Okay. Can you see the first autocorrelation is very close to 1.9? Okay. So similarly, you can see the other series also have the same kind of structure. Okay. And we can do that. If you look at the partial autocorrelation function, it's even more revealing. Partial autocorrelation function of hog supply, see what we get. Can you see that it's all, you need to do the differencing of the series. Okay. So generally you would see that when you do the hog data, all 5 series are non-stationary. Okay. So let me write here. This is for the hog data. All series are non-stationary. Okay. So I think here we are doing some simple check to show that whether the series are non-stationary or not. But I think we should use formally the Dickey-Fuller test, ADF test. I think if you look at the notes that I have posted on the Blackboard in my book, there is a section that deals with that. You may want to take a look at it. Okay. So what does the Dickey-Fuller test do? Dickey-Fuller test is based on the following concept. If you have an AR1 model, let's assume that I'm just going to use the univariate case, yt minus 1 plus at, univariate case. Okay. So checking whether the process is stationary or not, we are checking the pi coefficient is equal to 1. That's what you are checking. Okay. Pi coefficient is equal to 1. Okay. And what it means is that essentially regress yt on yt minus 1, right? And you can compute this pi hat, right? Very easy to do. And then I think you can also compute the t ratio that goes with that, right? What is the t ratio? Is going to be pi hat. In this case, you are checking my 1, so it's going to be pi hat minus 1 divided by some standard error of pi hat, right? But one can show that if pi is equal to 1, this distribution is not t distribution, it follows a different distribution. So you have to use totally different set of tables. Okay, and those tables you'll see that under normal circumstances, if this number is greater than 2, we are going to say, you have to reject it, right? So, but it's going to happen that that number is going to be slightly larger than 2, and then you have to go through the calculations. Okay, so refer to Dickey-Fuller test. I have given it in the notes, so you should be able to check this. Okay, and there is something called augmented Dickey-Fuller test. It is just extending this to higher order autoregressive process. So the idea is fairly simple. Let me set it up, because that way you can see the connection between this and when we do the other more complex modeling. So in the case of higher order models, we have pi t yt minus 1, pi 2 yt minus 2 plus at. Okay. Here checking whether one root is equal to 1 is not as simple as setting this pi 1 and is equal to 1. So you need to do a little bit more little bit difficult here. The way it works is as follows. As I mentioned before, if the roots of this equation lambda 1 squared minus pi 1 lambda minus pi 2 is equal to 0, if the roots of this equation, one of the root is equal to 1, that means that there is a non-stationarity issues. So this is same as writing this is equivalent to, if you solve this one, it's going to be lambda minus lambda 1, lambda minus lambda 2 is equal to 0, right? You have two roots, so that must be equal to 0. So this is same as writing lambda squared minus lambda 1 plus lambda 2 times lambda and plus lambda 1 lambda 2, this should be equal to 0. The roots of that should be taken out. Okay. So essentially what it means is that you can take this equation here. So I'm going to take the AR2 equation, write it in this form: 1 minus pi 1 b, so backshift operator, pi 2 b squared times yt is equal to 80. That's what we have. Okay. So these lambdas are nothing but, you can call it as b, inverse of b, and you can match it with the quantities that I have there. So essentially what it means is that lambda 1 plus lambda 2 should be equal to pi 1, and lambda 1 lambda 2, the product should be equal to pi 2. Just take these quantities here and match it with this, and before I forget here, I think I want to mention that both lambda 1 and lambda 2 are supposed to be less than 1. Lambda 1 and lambda 2 should be less than 1, less than or equal to 1. I'm going to assume that lambda 1 is greater than lambda 2. Okay. So if you want to test one of the roots is equal to 1, essentially you can say that lambda 1 is equal to 1. Is equal to 1. So if that is the case, you can see from here lambda 2 is equal to pi 2. Okay. Am I writing this correct? Yeah. I'm sorry, I think I should have written it in the signs were not correct. Let me. Lambda 1, lambda 2 should be equal to minus pi 1, and lambda 1 and lambda 2 should be equal to plus pi 2. I'm sorry, I'm not writing this correctly. No, lambda on pi 1 is correct. Should be minus pi 2. That's what that was a mistake. So if lambda 1 is equal to 1, you can see lambda 2 should be equal to minus pi 2. So if lambda 2 is minus pi 2, you can see from here, essentially the constraints on lambda can be translated as a constraint on pi's. So this essentially gives you this is going to be 1 minus pi 2 is equal to pi 1. So this implies that pi 1 plus pi 2 is equal to 1. And you can see that pi 1 plus pi 2 is equal to 1, and then you're checking whether lambda 2 is equal to pi 2. Okay. So that is the constraint that you have. So which means that you can take this model and rewrite it in a slightly different form, and so you can write it as yt is equal to, so you have pi 1. I'm going to add this pi 2 here and then write it as yt minus 1. Since I added pi 2, I am going to take it out. The way I am going to take it out is that I am going to write it as minus pi 2 times yt minus 1 minus yt minus 2 plus epsilon t. Okay. Do you follow what I have done here? Essentially what I did was to, because pi 1 plus pi 2 is equal to 1 is the result of assuming this lambda 1 is equal to 1. So I'm going to use that fact to test it out. Okay. So I'm going to do one more simple adjustment, then it becomes clear. Okay. So I'm going to subtract yt minus 1 on both sides. The reason being that you'll see it's going to be pi 1 plus pi 2 minus 1 yt minus 1 minus pi 2 yt minus 1 minus yt minus 2 plus epsilon t. So you can see that testing whether lambda 1 is equal to 1 is same as testing whether this is equal to 0. Okay. I think I should have made the same adjustments here. I think let me go back and correct this, and I think that might be the best way to do this. So essentially what I am going to do here, since I am checking whether pi is equal to 1, I am going to subtract yt minus 1 on both sides. So this is same as checking pi hat minus 1, sorry, pi minus 1 yt minus 1 plus at, right. So checking whether pi is equal to 1 is same as checking whether pi minus 1 is equal to 0. Okay. So essentially this is going to be, that's the reason I was going to say that. So you're going to run the regression of this quantity here. This is the call it Wt, which is the difference of the series. I'm going to call it as pi star yt minus 1 plus at. So this is same as writing, let me change this to, it's going to be pi hat star and then standard pi. So refer to the Dickey-Pullett test. So what is the reason I am going through this is that there is a pattern that you will see. So if I call this as Wt, yt minus 1, you can see that this quantity is Wt minus 1. So this is like pi 1 star yt minus 1 plus, I'm going to call it as pi 2 star Wt minus 1 plus epsilon t. Okay. So now you can run the regression of Wt on yt minus 1 and Wt minus 1, and you check if this coefficient is 0 and using the usual t test, but the tables that you want to refer to are going to be different. Okay. So, this test here is known as augmented Dickey-Fuller test, ADF test. Okay. And this form of writing, Wt in terms of Yt minus 1 and Y epsilon t, sometimes this is known as error correction form. Error correction form. Okay. It has some interpretations in economics, and if you want to read more about it, you should look at Granger's work on this. Okay. So, this is the general form of testing whether you have non-stationarity or not. Okay. But in the case of multivariate multiple time series, it takes a slightly different turn, mainly because instead of dealing with scalars, you are dealing with matrices now, right? So, you need to be careful about how you do that. Okay. So, this is where I think the concept of co-integration and other things come into play. Okay. So, let me So, in the case of multiple time series, what is the relationship? In the case of multiple time series, we have a matrix here pi Yt minus 1 plus epsilon t. Okay. Now, we have all these are high dimensional vectors and matrices, you have m by 1. Okay. So, when you say the eigenvalues of pi should be less than or equal to 1, but I am going to make the same adjustment I made for the univariate case. I am going to subtract Yt minus 1, and here I am going to write it as pi minus I times Yt minus 1 plus epsilon t. Okay. I am not doing anything difficult here, I am just subtracting Yt minus 1 on both sides. Okay. So, if the eigenvalues of pi are going to be on the close to 1, what would be the eigenvalues of pi minus I? If pi goes to 1, pi minus 1 should go to 0. Okay. So, if the eigenvalues of this goes to 0, that indicates that there is non-stationarity issues. Okay. And the nice thing about this is that there is a result that, particularly I think I've done some work in this area. So, I am going to write this as, say, Wt is equal to, call this as pi star, and then this is Yt minus 1 plus epsilon t. Okay. So, this again forms in the framework of regression C of x t plus epsilon t. So, essentially we are saying that some values of this pi star is going to be close to 0, which also means that eigenvalues of this pi star is going to be 0. Okay. So, which means that rank of this matrix is going to be lower than m. If that is the case, there are some nice features that comes up that you can use. So, let me just for illustration, I am going to write this here. Say this is m by 1, this is n by 1, this is m by n. So, essentially what we are saying here is that rank of this matrix, C matrix, is not full rank, it is going to be R. I am going to write it as it is going to be minimum of the 2 m and n. Okay. So, it has some nice implications. That is the reason why I am spending a little bit of time to develop this, because you will see that the famous Johansson test follows from here. So let me go back to the, okay. So if you see this, so this is this slide that I have on reduced rank regression, okay. So if the matrix has lower rank, there are two implications. The first implication is that, so there are linear combinations that you can take that are Li prime C is equal to 0, and there is also the flip side to it is that you can take that matrix C and decompose into two parts, A and B, which are given as A is M by R matrix and B is R by N matrix, okay. And the constraints are not known to you, you have to estimate it from the data. And similarly, if you look at the model 7 that I have given there, y and x are the only quantities you know. You have to estimate C, and you have to estimate what the rank is, you have to estimate L, you have to estimate A, you have to estimate B, and so on, okay. So lots of numbers that you have to estimate, and you have to put some constraints to make the estimation possible, okay. So there are some simple features that I want you to understand here, and which I have not added to the slide, mainly because it was getting too technical here. So there are two implications. The first implication is that there are constraints on C matrix that you can use. So essentially the constraints are that if I take that L prime yt, this is going to be L prime C xt plus L prime epsilon t. Okay. So what is L prime C? What is L prime C is 0. Can you see that? Okay. So this drops out. Essentially we are saying that L prime yt is L prime epsilon t. Epsilon t is supposed to be random. Essentially we are saying L prime yt is random. So those linear combinations have nothing to do with xt, and this is some very profound implication in macroeconomics. If any one of you interested, you can take a look at it. But the second part of it is the one I am going to use. The second part of it is that yt is equal to a times b times xt plus epsilon t. Okay. And b is supposed to be of dimension r by n, xt is of dimension n by 1, and essentially what we are saying here is that you can take n dimensional series and reduce the dimension to r, so that b times xt is the only set of linear combinations you need in order to see the relationship between yt and xt. So in practice you will see that r is pretty small number. In macroeconomics there is this theory that economy is driven by one real factor, one monetary factor, or okay. So real factors is like unemployment or physical goods that are produced. Monetary factors are like money supply, interest rates, and so on. So usually this theoretically it's supposed to be of dimension 2, but it never works out that way. Okay. But generally I think that's main idea is that you can reduce the dimension. Okay. But here I think we are not going to use that concept in that fashion. Okay. So given a set of data y and x, how do you know that the dimension is less than full dimension? How do you check? Okay. How do you check the dimension? Okay. So this goes back to the connection between correlation and regression, right? If the correlation is 0, what kind of linear regression you are going to see? 0, right? I mean the coefficient is going to be 0, right? I'm not talking about nonlinear regression, just a straight line regression. Okay. The same concept applies here also. Instead of using correlations, we are going to use the canonical correlations. canonical correlations are nothing but correlations between two sets of multivariate vectors. Okay, and those are very easy to compute, and there are lots of programs that do that for you. The simple test that one people use is that you can use the canonical correlations and decide how many of them are significant and use them. And if in the case of hog data, we are going to have 5 canonical correlations, right? And the way we are going to use that is that the largest canonical correlations would decide how many observations, what is the rank of R. The smallest canonical correlations will give us the L. You can decide how you want to use them. Okay, but let's not go too much into this. But my focus is going to be on multiple time series concept and the concept of co-integration. Okay, so in the case of co-integration, we are going to check how many roots are non-stationary. Okay, so let me briefly check this out. So essentially, we are going to check Wt, and then we are going to regress on this quantity here, pi star yt minus 1 plus epsilon t, and rank of pi star will decide, rank of pi star should decide the number of unit roots. Number of unit roots. Number of unit roots. Okay. So, if the rank is 0, that means that all the roots are unit roots. So there is no way you can do any reduced rank regression. If the number of unit roots are somewhere between 1 and 5 in the case of hog data, you can use that information to do the following. This is the key part that I want you to understand here. Because pi star is going to be of lower rank, you can write it in the following form. Instead of writing A and B, I'm going to follow the standard notation Johansson uses. This is alpha times beta prime times yt minus 1 plus epsilon t. Okay. So if the number of units roots are, say, certain number, I think you should be able to incorporate that information here. Okay. So this quantity here, beta prime yt minus 1, is called co-integrating relationship. Co-integrating relationship. Okay. Essentially what they mean is that beta prime yt minus 1 should be roughly stationary series, and if they are stationary, and that information comes very handy if you are connecting multiple financial time series. The difference between some combination of that is stationary, and whenever that stationarity condition is, if it is stationary, it's supposed to bounce around a certain mean, and if it goes beyond a certain mean, that means that either you should buy or sell. Okay. So that's the kind of decisions you can make based on this co-integrating relationship. Okay. So I think I've covered quite a bit here, but I want to show you a concrete example here, and so that you can see how these things work. So let me show you the following. Okay. I have a program that I posted on on the coursework. You should be able to check out the details there. So let me I'm using, let me show you the program that I have. Okay. think one of the program that I've used is written by Say. I think it's given in the book. So I tend to use the package MTS, and there is also a package that you have to use that's called F unit roots. And the reason why we do that is the following. Okay, so let me talk a little bit about the co-integration setup. Okay. Co-integration setup. I think the first you should do is that for the data, try VAR modeling. Okay, vector autoregressive modeling. Okay. Generally, if the order of the process is fairly large, that would indicate that the process is non-stationary, right? So you should be able to quickly decide based on that information. You have to check for non-stationarity condition. Okay, so that's VAR modeling. First, you should see that, and the goal again is to get parsimonious modeling. Parsimonious models. Okay. So in order to do co-integration, we are going to do the following. Check if all series are non-stationary. Okay. So what is the procedure you would check? We just saw the Dickey-Fuller or augmented Dickey-Fuller test, right? For each series you can check, use ADF test. Okay. And the third step is to do Johansson test. Okay. I'll go through each one of these very carefully now, and then we can. Okay. So this is the program that I already have. So if anyone wants to take a look at it, you should see that. Okay. So you have to install these packages and go through the calculations. So what I'm going to do here is to just show you some output. So these packages take a little bit of time to copy. So I'm going to read the data. Copy. So this file you see saw that I'm going to select only the first 5 columns. All the other columns are just the lag values, so I don't need it. Copy. And I have it here. So I'm going to fit this model here. This is AM1, that is the first thing I want to do. This is the vector autoregressive model. It's going to tell us how many lags you need using several criteria here. Okay. So that's what it gives me. Okay. So if you look at it, how many lags you would include? Either you go by AIC, BIC, or Hahn and Quinn's test. You can see the number of lags they recommend is 13. Can you see that? That usually means that the process is non-stationary. Okay. Usually you should get much more parsimonious models. Okay. So let me see if I could get what the summary measure of M1 gives. I didn't bother to check. So if you look at the summary measures here, I think it pretty much gives the same thing. Okay. So now I'm going to do the few things. The second step that you want to do here is that you want to check if all series are non-stationary, right, using ADF test. Okay. And just to illustrate that, usually when you look at the partial autocorrelation functions, you should see fairly high values at lag 1, and then they should disappear after that. So just will confirm for one of them, and you can do for all of it. So that's how it looks. Okay, that's a partial autocorrelation function. So the next thing I want to do here is to do this ADF test. So let's do it for I'm including lag 2. It doesn't really matter if that coefficient is 0, that's going to vanish anyway. So I'm just going to test the ADF test. Okay. So paste. So that's what you get. Okay. You can see that augmented Dickey-Fuller test, it goes through the Dickey-Fuller test statistics. P-value is 0.065. You are going to use 5% level, right? You can accept it. You can check it for every one of them. Okay. But the next part is the one that I want you to follow. That's that Johansson test. So this is what it is. Giving k is equal to 2, that is the order that I am checking. For whatever reason, it doesn't work if I give anything less than that. I need to look into it. So, but in any case, this is what I have. Okay. And then I'm going to get the summary of this. This is the information. This is the part that I want you to understand here. You can see that the test statistic is given on the first column, and the table values are given for 1%, 5%, and 10% levels. Okay. And again, because it doesn't follow any standard test statistic, you have to rely on this output here. Okay. Because remember that I mentioned, when you're testing for non-stationarity, you cannot use the standard T tables, you have to use the special tables. Okay. So if you look at the first one here, rank of 0, test statistic is 74.18. So if you compare it with any of the percentage levels, you can see that you are going to reject that hypothesis. Okay. So that's not valid. Rank is equal to 1. You can see the test statistic is 35.98. And again, it is larger than any of the numbers. You're going to reject it. But if you look at the rank is 2, what do you see? 17.90, right? So that seems to be accepted, right? So afterwards, I think you should see automatically other things should be accepted. Okay. So based on this, you can say rank of the pi star minus I is equal to 2, right? If rank is equal to 2, how many eigenvalues are 0, how many eigenvalues are 1. Remember, we are checking pi star, right? Pi star, which is pi minus I, and the rank of that pi minus I is equal to 2, right? So how do you translate that into non-stationary and stationary values? Okay. The rank is equal to 2, that means the 3 of the eigenvalues are supposed to be 0, right? That means that there are roughly 3 non-stationary series and 2 stationary combinations. Okay, can you see that? So we started with 5 series and each one of them was non-stationary, right? And if you difference the series, you may wipe out all the information that you have. This procedure tells you that 2 series might be stationary, 3 might be non-stationary. Okay, so we are going to exploit the fact that there are 2 series that are stationary in the context of financial modeling. Our goal is to convert non-stationary series into stationary series so that you can use the property of stationarity. If it deviates from the mean too much, right, then you make some trading decisions. That's the idea behind this. Okay, so just to give you an idea here, how do you read this? Okay, so the way I would read this is as follows. Okay, so you can see that the first column gives you the combination, linear combination associated with the first significant eigenvalue. Essentially what we get here is this, I erase that one. Okay, so you get this column here, beta prime yt minus 1. Okay, so you can see the first column gives you the eigenvalues associated with the eigenvector associated with the first eigenvalue, and the second, third, fourth, and so on. Okay, so essentially what we are going to show is that the last 3 series combinations are going to be, last 2 definitely non-stationary and the first 2 definitely stationary. The one in between sort of going to fall in between the 2. Okay, so I took those linear combinations. So what I'm saying is that this is going to be 1 times hog supply minus 3.2 times hog price plus 1.22 times corn supply and so on. I took those linear combinations and I constructed what I call as canonical variables. So I've already done this here, I have them here. Can you see that? These are the last 5 columns here, canonical variables. I'll post this particular file also, you can check, So those are the 5 variables that I have. Okay, I want to show you the picture so that you can see how this works. So I'm going to go for time series plot of the original data. So this is hog supply to wages. So you can see that's it's original data, right? So this is what we did now. All series look non-stationary, right? So now with this co-integration idea, after we did the co-integration, let's look at the plot of the canonical variables and see how it looks. That's a canonical variable. Can you see the first 2 series are fairly stationary, right? And the last 2 series are definitely non-stationary. The third series somewhere in between. Can you see that? Okay. So I think we are going to exploit the fact that we can find linear combinations that are stationary, right? So whenever this combination exceeds some value, that means that we are going to make a trade. Okay. So in pairs trading, essentially this is what is done. You look at 2 series that are moving together and you find some sort of combination that is stationary and use that information to trade. That's the idea. Okay. Any question on this? This is a course by itself, multiple time series modeling. I try to do too much here. Okay. Any question? Any question here? Okay. If any of you are interested, I can post copies. We have a book on this topic. It's called Multivariate Reduced Rank Regression. It was published about several years back, and I can make some copies and post it for you. Okay. I do have, I think, PDF file somewhere. I think I should be able to post it. Okay. Any question? Any question? Okay. Generally, I think the main idea here is that when you are going to study multiple stocks, they are likely to be, each one likely to be non-stationary, and they are likely to move together if they are in the same sector. Then you should be able to find some combination that is stationary, and you can use that fact to do that. You can use that fact to establish some trading rules. Okay. Okay, I think we spent a lot of time on methodology part of it. This pretty much finishes most of the ideas that you need to know for the trading algorithms. So I'm going to start on you will see that the trading algorithm part comes in 2-3 small areas. That's the way I've divided this. The first part of it is going to be traditional technical rules applied to one single asset, and the second part of it is going to be technical rules still apply to one single asset, but bringing in addition to price information other factors. And the second part of it is going to be on considering multiple stocks, pairs trading, co-integration ideas. And the third part of it is going to be using high frequency data in trading. So that roughly is the idea behind it. Okay. And the techniques that are used in all three situations are more or less the same concept, coming up with stationarity conditions and making sure that we can exploit that stationarity condition. Okay. So I mentioned before, I think we talked about this when to trade, how to trade. When to trade is the decision we are going to make on technical rules, and how to trade depends upon which exchange you want to send your order to. There is a huge amount of literature on this. And what is the market impact of the trade? This is the area that I've done some research. The idea behind this estimation is that once you enter the market, you want to study how the market is likely to behave. Okay. So when to trade, how much to trade, it depends upon person's individual utility and liquidity constraints. So generally, I think you will see that market is divided between informed traders. These are traders who follow the market very closely, and then you have the noise traders who want to trade for liquidity reasons. Okay, and so there are two approaches: fundamental versus technical analysis. So fundamental analysis says that price is so efficient, it should incorporate all the information that comes out very quickly. And technical analysis says that there is a pattern to the price, so we should be able to exploit it. Okay. So there are trading strategies. I think there are broadly divided into qualitative and quantitative. And qualitative rules are not not that much used, but mostly quantitative results. The first one is the technical pattern recognition. This is almost like looking at the price diagram to see if there is any broad patterns that you can see visually and see where the price is going. Okay. Here I think tend to use mostly non-parametric techniques, because most of the, when you see a picture, you probably focus on the location of the, where the changes are taking place. So it's mostly local smoothing ideas that come into play. Okay. But as far as quantitative techniques are concerned, we are going to look at filter rules and all the moving average based rules and so on. We'll also talk a little bit about pairs trading. This is an area that's got a lot of attention. And then the fair value model. Fair value models are gauge the return against market return and see whenever there is deviation from that, how do you exploit that. Then there is some work on directional forecasting. Here you not only forecast the change in price or change in return, but you forecast whether the price is going to increase or decrease, and then you forecast the size of increase. Just do it in multiple steps. Okay. So what it does is that it leads to nonlinear models which are supposed to be behaving better than linear models. Okay. So what are trading algorithms? These are predefined set of rules for execution and that are devised to optimize a cost function or to meet a specified goal. Okay. So the cost function could involve, if there is a too much drop in the price, you may want to get out of the market. And if it's on the profit side, you can also decide after you made enough profit, you may want to get out of the market. Okay. So these algorithms are schedule driven. I think most of the automated rules are schedule driven, but you always have to evaluate this rule as you go along. And there is also opportunistic algorithms. You constantly watch the market, and whenever you see that one side, demand or supply side, is doing better, you may want to jump on that side. Okay. So market trade, I think we'll talk about some of these things later. Slippage is an important concept, and temporary impact and permanent impact. The main difference between temporary impact and permanent impact is that as soon as you enter the market, how you are able to alter the price, that's a temporary impact. Permanent impact is that after you are done trading all you want to trade, how does it change the price? Okay, usually that is taken 30 minutes after you end the price, how the price is. Okay. So in all these things, I think you will see the main goal is that when you come, there is a price, and if you trade all your quantities, that is the price you are going to get. But if you are going to trade slowly and in sequentially, you want to decide at the end of the trade what is the price that stands. The difference between the two should roughly indicate how much you have influenced the price. Okay. But most of the players, even the big players, their part is going to be fairly small, 5-10%. Okay. So lots of other players are also could influence the price. So that concept is still it's not clear to me how much you can use that. Okay. So people always ask me, is algorithmic trading new? No. People always use some sort of algorithms to enter the market, to get out of the market. And electronic trading almost always implies high frequency trading. And in the high frequency trading world, you need to have some algorithms. Otherwise, you can't be monitoring the market so closely. You just have to do that. Algorithmic trading is not exactly equivalent to high frequency trading. We'll talk about it. Okay. So I think the question is that in electronic trading, is the time scale compression the issue? Okay. Because the transactions that were occurring every hour or every day, now it has become every millisecond, right? So are we taking the time and putting it in such a minute interval? So, is that the compression issue? It's more than that. Is the trading behavior different? Yes, the trading behavior is very different, mainly because you will see that when we look at the order book data, people come, post the orders and leave very quickly. Okay, and why do they do that? I think they're just testing out the market. Okay, I'm going to use the same setup that we talked about before. It's still, I'm going to treat this as a prediction problem, because ultimately you have to see where the market is going and then decide how we want to enter. Okay. So in the low frequency, predictability of stock return is the key, and there are some studies, very macro studies, that talk about how you can predict the stock returns using those variables that I mentioned here: interest rates, money growth rates, inflation rates, and at the company level you can use price earning ratios and dividend yields. Okay. And there are two types of studies. I think you'll see that people have studied quite a bit forecasting the overall market, S&P 500. At the disaggregated level, I think you have to see whether individual stocks are doing well. So general finding is that predictability is more pronounced in periods of regime switches, which means that either the prices suddenly starts going down or going up. In those cases, you can predict better. Okay, but if the price are stable, going to be bouncing around, there's no prediction problem there. Okay, I think this is probably the. Let me see. I think I'll get to it. I will end here. I think this is the important slide. Okay. Prices generally follow random walk model, right? So if the random walk model with zero or positive drift, Fama and Bloom clearly show that no rule will consistently outperform buy and hold strategy. Okay. I think I should say that no single rule. Okay. So which means that you cannot make money with just knowing one rule. You need to have bunch of rules in place. Okay. And the second is, there is no obvious relationship between the magnitude of serial correlation and expected profits of a mechanical trading rule. Although there is no obvious relationship, generally I think if there is serial correlation in the prices, you should be able to exploit that in some form. Okay. So if any of you want to read this paper, read about the skepticism about the entire algorithmic trading, you should look at this Fama and Bloom paper. Okay. It's a very, very nice paper to read. Okay. I'm going to stop here. I think we'll start on all the technical rules next week.